While Wall Street debates AI infrastructure, China's financial system is moving in a different direction. Faster deployment, broader integration across platforms, and way more real-world transaction data. This could turn into one of the most important AI competition stories of the decade. Because financial AI isn't just about model capability, it's about data, workflow integration, behavioral understanding, and deployment scale. And in those areas, China may be more competitive than most people realize. In many Western countries, financial systems remain fragmented. Banks are separated from payment systems. Payment systems are separated from e-commerce. Consumer data is scattered across different platforms. China took a different path. Mobile payments became deeply integrated into everyday life: food delivery, ride-hailing, e-commerce, digital wallets, consumer lending, wealth management. Large portions of daily economic activity went digital, fast, and from an AI perspective, digitized behavior is gold. Because financial AI systems improve through behavioral feedback, patterns, transactions, repayment history, consumption habits, risk signals. The more connected the system, the more data feedback loops exist, and AI systems thrive on feedback loops. This is one reason many Chinese fintech firms got very good at intelligent risk control years before the current generative AI boom. They were already processing enormous amounts of real-world financial behavior. Let's start with Ant Group. Ant isn't just building AI tools. It's building platform-level financial infrastructure, payments, cloud computing, risk control, wealth management, enterprise finance. The goal isn't to sell AI software. The goal is to embed AI into the financial operating system itself. That distinction counts, because companies that control operating systems often control long-term platform value. And China's fintech landscape is unusually interconnected, which creates conditions where AI deployment can happen very quickly. This may become one of China's largest structural advantages in financial AI, because deploying AI at scale is often harder than building the model itself. Many AI systems fail not because the technology is weak, but because enterprise integration is difficult. China's financial infrastructure may have fewer integration barriers than many Western systems, and that changes deployment economics. Chinese fintech firms like Du Xiaoman spent years building intelligent risk control systems, long before generative AI became fashionable. This is a big deal because finance is, at its core, a risk management industry. Every loan decision is a probability calculation. Every credit approval contains uncertainty. Every transaction carries risk. AI systems become very powerful in environments with large-scale behavioral data, and China generates enormous amounts of digital financial behavior every day. An AI system analyzing millions of repayment patterns may eventually identify risks that traditional systems can't easily detect. This creates a feedback cycle. More users generate more data. More data improves risk models. Better risk models attract more users. And over time, that builds extremely strong network advantages. This is why many Chinese fintech companies became highly advanced in behavioral analysis years before the current AI boom captured global attention. One of the more interesting ideas comes from Bairong. They describe some of their AI systems as silicon-based employees. That phrase sounds dramatic, but the business logic behind it is important. Instead of selling software licenses, some Chinese fintech firms are increasingly experimenting with outcome-based AI services. Not paying for the tool itself, paying for the result. That changes incentives completely. In the past, business model innovation could count as much as technological innovation, especially in finance, because financial firms ultimately care about outcomes, lower default rates, faster approvals, reduced compliance costs, better operational efficiency, and AI systems that directly improve those metrics may become deeply embedded into enterprise operations. The United States still focuses heavily on productivity enhancement, helping analysts work faster, helping researchers summarize information, helping employees reduce repetitive labor. China increasingly focuses on operational replacement and platform integration. That difference is the real key because it changes pricing models, deployment speed, adoption incentives, labor structures, and long-term industry economics. And over time, these structural differences may produce two completely different financial AI landscapes. One centered around workflow enhancement, the other centered around platform-level operational integration. And investors may still be underestimating how large this divergence could become. Many investors still focus heavily on headline AI companies, OpenAI, Anthropic, Google, NVIDIA. But looking back, infrastructure transitions often create value in unexpected layers. During the internet era, some of the most valuable companies were not the first websites. They were infrastructure providers, cloud systems, payment systems, operating systems, advertising infrastructure. Financial AI may follow the same pattern. The most valuable companies may not be the ones with the smartest demo. They may be the firms deeply integrated into enterprise workflows. A compliance system connected to a bank's internal operations may become more defensible than a flashy chatbot. A workflow automation platform embedded inside a securities firm may generate more stable long-term value than a consumer AI app. And this is where China becomes especially interesting, because China's industrial and financial systems often evolve through integration rather than fragmentation. That creates conditions where AI infrastructure may scale very quickly once deployment economics become attractive. Financial AI is no longer a future concept. The infrastructure transition has already started. And the next phase of competition may not age between OpenAI, Anthropic, or Google. It may become a competition between two wholly different financial systems, Wall Street and China's digital financial infrastructure.
The winners not be the companies with the most impressive demos. They may be the companies that become deeply embedded into how capital actually moves. Because in the end, real enterprise value usually comes from deployment, not demos. And the firms that quietly control financial workflows may ultimately become more important than the firms generating the loudest headlines. Thanks for watching. If you enjoy my video, make sure subscribe to China Alpha Hunter, and I will see you in the next episode.